The SPYM S&P 500 ETF with the ticker SPY is one of the largest and most well-known ETFs in the world, with nearly $700 billion in assets under its management. In fact, the fund has been around since 1993, making it among the oldest ETF in existence, and since then it has tracked the S&P 500, which represents the performance of the 500 largest publicly traded US-based companies. But what many investors don't realize is that there's a nearly identical ETF known as SPYM that just recently changed its name from SPLG, and now SPYM stands for the State Street Spider Portfolio S&P 500 ETF that aims to do the exact same thing but at a lower cost than SPY. So in this video, I'm going to break down the key similarities and differences between SPY and SPYM, and by the end of the video, you'll see how the difference, depending on how you invest, could save you thousands of dollars over time. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first start off by going over what SPY and SPYM have in common. So both SPY and SPYM track the same index, the S&P 500, which means when you buy either of the funds, you are getting exposure to the exact same 500 companies that represent the core of the US stock market. And when you look into those top holdings, they're nearly identical, where you can see companies that you've heard of like Nvidia, Apple, Microsoft, and Amazon that all make up the top spots, and between SPY and SPYM, they have pretty much the exact same amount of exposure that goes to each. On top of that, both funds are heavily weighted toward the information technology sector at roughly 36%, followed by financials and consumer discretionary, where you can also see they both track nearly the exact same amounts as well. And because they're both ETFs, they can be traded throughout the day just like any ordinary stock, offering real-time pricing, a variety of order types, and even options, with even more liquidity than mutual funds. So at a first glance, SPY and SPYM look very similar, but now let's break down where they actually differ. The first and most important difference to mention here is the cost, because SPY currently has an expense ratio of 0.0945%. All this means is that you will pay $9.45 a year for every $10,000 that you invest, where on the other hand, SPYM has a lower and more simple expense ratio of just 0.02%, which equates to $2 per year for every $10,000 that you invest. Now, I know that sounds like a super small difference. It's literally the comparison between a box of pizza and a slice of pizza, but over decades of doing this, the savings compound and can create a larger impact. For example, if you invest $10,000 upfront and add $500 every month for 30 years, assuming a 10% average annual return, with SPY rounding down to 0.09% of an expense ratio, you'd pay close to $21,000 in total fees. Where if you instead did this with SPYM, you'd end up paying under $5,000 in total fees, which would save you over $15,000 just from the difference of typing one more letter and clicking the button for SPYM rather than SPY. Now, understand this difference only matters and has a true impact if you are one investing for the long term. To see a true comparison between the two ETFs' historical performance, with the expense ratio already factored into each, SPY shows over the past 10 years to have averaged about 15.15% per year, where SPYM, being cheaper by roughly 0.08%, actually averaged over the past 10 years 0.08% higher, being 15.23% per year. Now, this difference isn't always going to be the exact same, but typically over time, the cheaper option, because both track the exact same index, will allow you to have more growth on your investment. So because of that, SPYM is typically referred to as the better approach when it comes to long-term investors simply looking to buy and hold, where SPY is more often used by those actively trading or using option strategies, and here's why. You see, SPY is one of the most actively traded ETFs in the world, averaging tens of millions of shares traded daily, and its average over the past 3 months is among the highest, being close to 74 million shares traded daily. That liquidity means there's going to be a tighter bid-ask spread, which means there is a super small gap between the price a buyer is willing to pay for the shares, called the bid price, and then the price a seller is willing to sell the shares for is called the asking price. So as you can see, the previous 30-day median bid-ask spread for SPY is 0%, where SPYM is 0.01%, which may seem like a small difference, but depending on how you invest, that difference could easily add up. All in all, a tighter spread means that you lose less money on each trade, and is why active traders and those using options prefer funds that have high liquidity like SPY rather than SPYM. You can see that based on the numbers of trades, and assuming this is all within 1 year of trading, that the cost differential for SPYM on the right adds up greatly when compared to SPY, depending on the number of trades that you make. Where the study then shows a longer time horizon, say 10 years, and you don't actively trade your positions, the cumulative cost of ownership is much lower for the cheaper expense ratio that is SPYM than picking SPY. Aside from all that, SPY being the first ETF ever created with great popularity, it currently has nearly $700 billion in assets under management when compared to SPYM that is much lower and just under $100 billion, with significantly less trading volume than SPY. Now, another difference to think about depends on the platform that you invest on, because SPY's share price is currently almost $700 a share, where SPYM is roughly $80 as of the recording of this video, which makes SPYM more accessible for smaller investors, specifically if you are on a platform that doesn't support fractional shares. At the end of the day, SPY and SPYM both give you identical exposure to the S&P 500. The biggest difference comes down to the cost, liquidity, and how you invest. Now, if you want to see this topic in more detail, consider checking out a recent article posted on InvestLane. Or if you are interested to see other videos we've created, like which is the best S&P 500 ETF, or the difference between QQQ and QQQM, which is very similar to this type of video, all the relevant videos that we've created linked in the description below for you. Plus, I'll also have a free index fund cheat sheet that I created that could help you learn more about some of our top index funds backed by data. Which, while you're at it, if you want to start investing on a new platform, I'll also have a direct link below to some of the top options available in the market. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. And as always, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.